All right, you beautiful humans, we're going to be breaking down some strategies and keeping it simple when it comes to investing. And maybe you happen to come across a little extra cash. And yes, even during these uncertain times, a little extra can be found. And now you're thinking about investing some of that money. But if you're brand new, it can feel like you need a translator to make sense of stocks, ETFs, Roth IRAs, compound interest. But do you really need a secret decoder ring? And look, it is not hieroglyphics here. There is no need to worry. This is your no-nonsense, step-by-step guide to getting started with investing in 2025. So let's break it down into 6 clear parts, and by the end, you will know what to do, when to do it, and how to avoid the mistakes that hold people back, even me when I was actually first starting. Now, part 1 is when you should start investing and when you actually shouldn't. So before you invest anything, ask yourself 2 important questions. And the first question is, do you have high interest debt? And I'm talking about that 15% or the average credit card interest rate right now at 23%. And if the answer is yes, you need to pay that off first, because paying off that debt with that 23% interest rate is like getting a guaranteed 23% return. You will never find that in the stock market. And then question 2 is, do you have that 3 to 6 month emergency fund? Because life does happen. It could be a chipped tooth or some other medical emergency, a job loss, I hope not. And of course, broken appliances if you're a homeowner. And if you don't have that safety net, you will be forced to sell those investments at the worst possible time if you don't have credit cards or any way else to get money. So clear your high interest debt, build that emergency fund, then you can actually start investing. And moving into part 2, why you should invest instead of just saving. So let's actually say that you have, let's say $1,000 hanging out in a savings account. You already have your emergency fund, but it's just $1,000 in your savings. You might think that you're being responsible, and it is nice to have a little bit of a buffer, but there is one problem, and it's a big one, and that is inflation. And so an example would be thinking about your streaming services. That is after you have consolidated and bundled those streaming services to save some money on that other video that I talked about. But Netflix used to be $7.99 a month before the ads. And then of course, eventually it moved over to $9.99 as the standard plan. Now the standard plan is $17.99. Same platform, same content, just a bigger bill. That slow and steady price creep, which seems to be happening every year, that is inflation in action, even though it may seem like corporate greed masked as inflation. But the solution is invest. So here is how your money grows when you invest. Number 1 is stock appreciation. Of course, let's choose Apple because it is a stock that I know a lot about. I have been invested in it for many years. And even though they don't always get favorable news, the company's valuation continues to go up, which means your shares go up in value too. And then there's number 2, which is compound interest. And this is actually where things can get a little silly. So your money earns money, and then that money earns more money on top of that. It is like a snowball rolling down a hill, and it just gets bigger and bigger and faster each and every year. Now let's actually step back with that $1,000. So even let's say that you get a 10% return, that might not seem like a huge deal. And I totally get that. But here's the deal. Once you start investing that $1,000 each and every month with about an 8% return, you could hit just under $100,000 in about 6.5 years. And if it's like a 10% return, then it's definitely going to be around 6 years. Then what happens is that you double that number in less than 4. So you understand how that compound happens, because eventually your investments are starting to grow by a very healthy 5 figures annually, and then eventually by 6 figures year over year. And this is without you doing anything new, nothing different. The earlier that you start, the more that math really starts to work in your favor. All right, so part 3, what to invest in as a beginner. Now that you know why to invest, let's actually talk about what to invest in. And a lot of beginners just make that mistake of chasing those hyped up stocks. And if you actually made out big on that GameStop situation that was like several years ago, hey, I celebrate your win. But those bros out there that are hyping up stocks that have no real fundamentals whatsoever, honestly, I just don't want you to be holding the bag. So instead of gambling on the next big thing, start with index funds and ETFs. These are actually bundles of hundreds of companies. So you're not betting on just one company, you're betting on the market as a whole. And some of these you may have heard of, where you got like SPY or VOO. These all track the S&P 500. Now, QQQ, that actually tracks the top tech companies like Apple, Nvidia, Microsoft, And it's actually a personal fave of mine as well. And here's what to look for. So it tracks big index, it fits your budget, and it has a low expense ratio, ideally under 0.5%. And ultimately, that is actually a fee that you pay when you are actually buying into these funds. I'll actually throw a definition up just so that you're aware of it. But again, when you have higher expense ratios, the more money you have, the more money that you're actually turning over. But you will be owning a piece of hundreds of companies without having to pick individual winners. And here's a quote that I love from Peter Lynch, and he was basically this legendary manager of the Fidelity Magellan Fund, and it is know what you own and know why you own it. And that's why I like ETFs. You're investing in something broad, simple, and proven. Now, part 4 is how to buy your first stock or ETF. And all right, let's actually walk you through how to actually make your first investment. I want you to we're gonna do a step-by-step here. So first off, you're gonna pick your brokerage. Some of the best are, you can use Vanguard, Fidelity, Schwab, or E-Trade. I actually have been with E-Trade for many, many, many years. And of course, it has been acquired by Morgan Stanley. And step 2 is you need to choose your account type. So I would recommend a Roth IRA for retirement, and then that taxable brokerage account, which is actually a nice little add after you have maxed out your annual contributions in your IRA. Step 3, open your account. So you need to fill out the info. Yep, your name, your address, social security number, and it really only takes just a few minutes. Then of course you have to fund your account, so you'll need to be linking your bank and deposit those funds. Now step 5, search for your ETF. So let's actually go back to that QQQ. So you type it in, and then once that gets pulled up, you're gonna hit buy, and then choose how many shares of QQQ that you want. You'll select the market order, and then just go ahead and click confirm. And then bam, you are now officially an investor. Now, if you actually want to see what is in that ETF, you can go to Yahoo Finance. And here's the thing about Yahoo Finance. I've been using Yahoo Finance even when Yahoo was like a search engine competing against Google, which they didn't seem to win that one. But I do recommend Yahoo Finance. And so what you're going to do is click on the holdings tab, and then you will actually see the names like Microsoft, Apple, Costco, and Google when it comes to that particular ETF. And you can see the percentages that is in that particular fund. In part 5, simple investing strategies that actually work. And here's the thing. The game plan is there's really nothing complicated. You got to think long-term. You got to invest for at least 3 to 5 years, and ideally longer, especially if you're not even near retirement. We are not going to be day trading here. So just keep buying, always be buying. And that's why you got to be consistent, because you're investing every month, no matter what the market is doing. That is called dollar cost averaging. And I will say that using Apple as an example, it is currently over $200 a share, but my holdings are averaged in way lower than that because I've held through all of these years and continue to reinvest. And it's actually gone through stock splits. And so it is really, really low, but I continue to reinvest my dividends from Apple, and I continue to buy Apple. So the thing is, don't panic. When the market dips, it is gonna dip, as we have seen recently. Don't sell in a rush. But let me show you why, and we'll use Yahoo Finance here again when we talk about the QQQ Trust, which that tracks that NASDAQ 100 index. So what happened is it experienced a significant decline during the 2008 financial crisis. I remember it. And I remember following it, and I even remember just watching it go pretty much in half. So what happened though is that it recovered, and it did reach new highs in the following years. So for instance, when you look at that historically, QQQ actually closed at $488 on May 2nd of just this year. So if you had invested during that downturn and held on to your investment, you would have had some substantial growth over that time. So you don't lose unless you sell. You gotta zoom out, stay the course, and trust that just like the house, the stock market is gonna win. And part 6, the final part here, is the common mistakes that new investors make. So we just talked about it when it comes to tripping up beginners, and that is mistake 1 is the panic selling, especially during a crash. The markets drop. You have seen it. If you have been following the market recently, it drops, it goes up, and it drops. Whether you think it makes sense or not, this is just the way it is. It is a very fickle existence. So ride it out and let time do its thing. And then of course, mistake 2 is trying to time the market. So if you miss just the 10 best days, your basically returns could be cut in half. So markets don't go up slowly, they surge, and basically when you least expect it. And honestly, I don't think we know what to expect these days. And of course, mistake 3 is investing money that you'll need soon. So, going back to that $1,000 that I mentioned, if you need it, I get it, but the stock market is not for your down payment if you need that cash in a year or two. So just consider that. If you need it to be liquid, then keep it liquid. And then of course, mistake number 4 is overcomplicating everything. You don't need 20 different stocks or to learn options trading. Start simple. 1 or 2 index funds just to get you started. Invest consistently and stay in the game. And of course, if you've made it here, let's do a little quick recap here. We got to pay off that high interest debt. We got to build an emergency fund. We have to start with low cost index funds. We're investing consistently. We're staying invested long term, and we are not overthinking anything. Investing is how you build wealth over time and not overnight. I would love to know where you are in your investing journey. Please hit me up in the comment section below. You stay informed and stay empowered on your next level up, and I will catch you right back here on the next one.